Welcome to both of you. Thomas, the idea that the Fed could go even more than originally expected this week, certainly playing a role. This week or in the next few meetings, there's now one 75 basis point hike priced in over the next few meetings. You think it's going to come on Wednesday. Why?
Yes. So I think one of the biggest reasons, point in favor for going 75 this meeting is because it's not expected. And that's because the Fed has found itself after Friday's data in a real pickle, in my opinion. The bedrock of their whole inflation targeting scheme, their whole policy framework, is steady inflation expectations. And what we saw in the University of Michigan Consumer Sentiment Survey last Friday is that those are starting to become unhinged. And as much as 50 basis points is baked in the cake from prior guidance that they've given us, it doesn't seem like it's a good move to me to just go with what's safe and then have to defend a relatively soft move in the press conference afterwards.
I just think it's unlikely because you have a Fed that has worked so diligently on its communication strategy and worked so hard to telegraph moves to the markets and be transparent. I think it would be a real shock. Maybe they need to do it to restore inflation credibility, but what would that do to its communication credibility when last meeting Fed Chair Powell said 75 basis points is not under consideration right now?
Well, he said that 75 basis points was not under consideration for that meeting. And he's also said many times that the Fed needs to look at the incoming data and react to it. So, in my opinion, a 75 basis point move is completely consistent with that. Obviously, you point out that they have been much more clear in their communication in the last 10 or 15 years or so in terms of sort of telling us exactly what they're going to do ahead of time. And that has some value at certain times. Right now, I don't think that that's the case. And I think that if the Fed were to just go along with their prior guidance, even if it doesn't necessarily match up with what the economy is telling them, that risks the credibility they've had building up, against inflation for the last 40 years. And once that's gone, I don't know how long it would take to try to rebuild that. And I don't think that Jay Powell wants to go down as one of the more irresponsible Fed chairmen in history for doing so.
A lot of notes today calling for a Volcker moment. Scott, how would the equity market react? And is that what today's broad and sharp and painful sell-off is telling you?
Yeah, I think what we're looking at here is the market quickly pricing in something that's akin to a recession. We've been arguing for a while now that as the market's teetered of late, that you're pricing in recession risk, but not the actuality of a recession itself. Our work in our recession scenario gets you to a 3650 level on the S&P, which is really a function of seeing a more severe hit to earnings expectations for 2023, combined with some multiple contraction. So I guess the way we would think about it is that the closer you get to our 3650 level, the more we feel like the market's pricing in something akin to a mild recession, which is tricky because we're still many months away from that recession actually taking hold. If it does, the house view here is still 50-50 chance of a recession for next year. So nothing's for certain at this point. And so I think that kind of speaks to some of the issue here in terms of discounting and a situation that is still kind of murky in terms of how it might unfold.